Welcome back, chumps. Welcome back to Chump Change Trading. And today we're going to strategize sort of what our future trades are for tomorrow. Today is March 14th. And as you will notice, this is after market hours. So you might be asking, well, what am I doing, when the market's not even open? Well, that's actually a good question, in that most of the work of options trading is really done prior to actually setting up the trades before the markets are even open. You have to sort of assess where you're at in terms of your portfolio and then figure out sort of what your next goals or your plans are. And so, unlike an equity day trader, you basically just trade whatever the market gives you. Now, we do trade what's given to us, like that. But the difference is with options, we really rely on the expiration dates on the contracts that we're buying and selling. So that way, your strategy, if you think the market's going up, you can set it for a 30-day window when you buy and sell options contracts in a 30-day time period. So you give yourself 30 days for your strategy to work, basically wherever you think the stock price is going to fall under. And that's what makes options trading kind of flexible and a little bit more relaxed than, the panic of day trading, buy, sell, buy, sell, buy, sell, buy, sell, right? You're basically going in with an intention, and then you're hoping that within that window of time period, it either expires worthless or expires in the money, depending on what your strategy is. So the real goal for this particular account is to sell premium. So that means that our goal is to be more of a contract seller than a contract buyer, because our goal is to basically take advantage of the price of the premium and let them expire worthless, so we keep all the premium and we just rinse and repeat. So as you can see, the account finally got funded with the 2000s, but as I checked into it, I am not allowed to trade, so I wasn't able to trade today until the cash in the account actually settles. Since this is a cash account, and I do have margins set up, really nothing kicks in until basically the third day. And so hopefully I'll be able to execute my strategy before the decision with before any kind of like big major moves, or even if it's after the moves of the PPI report that's coming tomorrow. So what am I going to trade, or what is the items that I'm going to look at? So I typically want to stick with sort of what I know. And so I'm in semiconductors, and this is a triple or 3 times leverage ETF in semiconductors, SOXL. I also will basically trade SOXX too. So one of the two things as I was looking at today is the movement on SOXX today was pretty parabolic, in the sense that it was moving up to the upside all throughout the trading day, and then ended on a high note too. And then now it's just sort of selling flat. So if we were to take a look backwards into where it was from a 2-week perspective, it's basically hitting sort of getting closer or consolidating right before it's historic 2-week highs. Basically, we move back 1 month, and that's pretty much where we're at level wise. There's really no other resistance levels that is going to really reflect where we are at. Maybe 420 is going to be the next resistance level, or level that I will know whether or not it's going to either bounce off or it's going to sort of rocket out of that location. So long and short is what I'm going to try to define as my support and resistance levels, what I'm trying to mention. So basically, a support is the bottom range of where the stock usually bounces off from its lows, and then the resistance level is usually the levels in which it bounces off from the highs. So the most basic and simple way to think about it, I'm just going to draw a price level, is that this line right here is the 424 425 level. If you were to consider that these two consolidation points, maybe I can bring it a little lower, this would be sort of like that level in which there is some historical resistance, right? It went up to there, bounced off this level, went back down, went up to there, bounced, hit that level or maybe exceeded by a little bit, and then bounced off and then went down below. And it's looking real close, and like it's actually created a newer low down here, so I can tell that that's not going to be necessarily a third time's the charm kind of deal on this one. So perhaps then this could be a signal that we're going south side. So there's all those factors to consider. Now, the next thing is, because I have a small account, what kind of strategy am I going to look into? Since I haven't really decided that we're heading, north side or south side on this particular position, or this particular equity or ETF, I'm thinking maybe I should just play it safe and try to just play for something in the middle. So there's kind of a, have your cake and eat it too sort of strategy. And my favorite go-to for that would be what's called an iron condor. So if I go to the options chain and I look at, let's say, this April 21st expiration date for a contract, that's 38 days away, I'll take a look at the strike prices for both the calls and the puts. So if you haven't seen this before, you can go ahead and I can send some resources and put some links into where you can find out what all these things mean. But if you have traded options before, I'm just gonna walk through it just so that I can sort of set up kind of like what is my cost basis into this strategy. So I'm thinking I want to sort of stay well below a 30 delta on both wings of my iron condor. So what I'm going to do is I'm basically going to probably pick, I would say, let's do it super safe because we have a small account. Let's sell a 385 strike price put and then buy the 380 put. And then on the call side, let's go for selling the 450 and then buying the 445. So this would basically constitute a symmetrical iron condor. Now, this strategy would give me a net of $2.15 in credit, but in contracts, the way that you price them out to just sort of like calculate what is it going to cost, you have to multiply it by 100. So this is $2.15, but if you were to multiply that by 100, that would be $215 for this entire position if I were to execute it. So if I hit review over here, this is sort of the amount of credit minus the cost of the fees that's going to cost me to basically execute that, because they take commissions on options at Thinkorswim. And then this is my buying power effect. So when I talk about buying power, this is exactly what I meant before, is that what is the account allowing me to sort of reserve in the event that something goes wrong in the strategy, okay? So this right here in Iron Condor is a defined risk strategy where the plus side, or what I win, is going to be defined, and there's a limit. My limit will be $212 maximum of what I can earn, and then the loss is also defined, and it's actually well put. If I were to be able to get out of this, I gotta redo it. Okay. It was the 385 there. And then I did the 445, 450. Yep. Something like that. I think it was 215 before, so I may have to move the wings went over. Maybe it's like this. Oops. There we go. All right, so if I scroll down here, it's a little tough to see. This will show you sort of what that profit and loss graph looks like. And you can see the actual on the left hand side as I move this scroll bar. Let me just zoom out just a little bit. If I move this scroll bar left and right, it'll actually correspond with the actual stock price, okay? And so this green area is my theoretical profit or loss, or profit rather, at the current strike price as I'm moving my mouse. But it has to be at expiration, okay? So this is a 38-day contract. And so the current profit or loss is this blue line. Since if I'm going to open this trade right now, it would be flat, right? Because, I just opened the trade. But as time goes on, as the stock price fluctuates back and forth, in this theoretical range that I just defined with my support and resistance level, my goal is to basically keep it within the confines of the support and resistance level, in hopes that as time goes on and the 38 days becomes 15 days and then it becomes 0 days, it will just basically expire worthless and I keep 100% of my profit. Right here is a little sort of time calendar. If I keep increasing the days, the dotted line, which is the theoretical profit point as of the day that it's set, will actually show you that as time goes on, the profit curve moves deeper into this sort of segment right here. So that means that at 34 days, if the stock price was $3.95 currently, I would be roughly a little bit more than 50% of the range of how much profit that I would have. And in that case, if I got 4 days to go, I might as well just close the position and just take the profit. So the goal is to basically take maybe 50 to 75% profit because I'm a bit greedy, but I will make a judgment call based off of the strategy if I'm cutting it real close, and I may have an opportunity to lose money, then I might as well just cut my losses and collect what I can. So that way, I don't waste time, and then B, I'm able to just keep whatever profits I can keep and not lose it all just because I wanted to squeeze every ounce of profit I can from this. So that's the main goal. So right now we are currently at 314, and obviously I created a range, right, for myself, and when I was setting up my ranges, I didn't exactly pick my 420 resistance level or my 400 resistance level, support level. I basically just kind of guesstimated. Why? Because I want to, in this particular small account, I want to make sure that the ranges are super wide enough that I'll never have to worry about if I was ever wrong about that sort of guess, that it would just sort of stay within that range. Because as you already know, the markets can move left or right, but I have to be sort of prepared for that. So this strategy is really, really strict once you set it, is that you can't manipulate it or move it or adjust it. It's sort of, you are right and you're right, or you're not right, and you need to close the position and cut your losses. So in this case, the most I could lose is 285 on this trade. The most I could gain is 215. So that's where the cost basis or the buying power comes into play.